What are all these red and green squares on my chart? If you're new to trading, this is how traders recognize price movement over a specific time. These are what are called Japanese candlesticks, and they represent 4 pieces of data: the open price of the candle, the close price of the candle, the high price, and the low price during that time duration. There's also a couple other definitions you need to know, such as the body, which is the area of space between the open and the close, and then the wicks. The wicks are the space between the high and the open or close of the candle, and then the low and then the open and close of the candle. The colors represent the market movement and the price action during that duration. If the candle is colored green, that means that the market price increased from the start of the candle to the close of the candle. If it is colored red, that means that the price decreased after the open of the candle and closed below the market price. So on this chart, you will see a bunch of red and green squares. So looking at this chart, let's pull up some examples really quick before we start looking at formations. So right here on the chart, we have a candle that I will select. And as you can see, it is colored green. There's 4 components, as I mentioned earlier: the open price, which is listed right there, the low price, which is down here below, the high price, which is up at the very top, and the close of the candle. What this means is the price fluctuated during the duration of this candle, and ultimately the market price opened up, moved around, and closed above the candle. That means the price increased from when this candle opened till when it closed. Likewise, on this chart, we have a red colored candle. And as you can see, we had the market price open and then close below. Once again, here is your open price. Here is your high price, the low price, and then the close price. So these are the 4 components for a Japanese candlestick. So now what? Well, a lot of traders like to use sequences of these candlesticks to help look for reversal patterns. What are reversal patterns? When the market price reaches a specific point and the individual expects the market price to reverse and find a direction to trade towards. So on this chart, once again, there are multiple different ways of looking at candlestick formations. There are tens of hundreds of different candlestick formations individuals like to utilize. I'm not going to cover all of them in this video, but I am going to show you several different formations that a lot of traders do use. Before we get into candlestick formations, it is important for the individual to understand decision versus indecision candles. I'm going to start with indecision candles. What is an indecision candle? An indecision candle is a candlestick that is printed to a chart that really doesn't provide any directional information for the individual. Well, right here on the chart, we have what is called a Dogee Candlestick. And a Dogee Candlestick is represented with an open price and a close price very close to the same price level, with wicks extending above or below the open and close price. It looks very, very truncated on this chart, and right here is an example of an indecisional candle. Another indecision candlestick a lot of traders recognize is what is called a spinning top. A spinning top candlestick is going to represent something like this. They can be either bullish or bearish. And all this does is basically show, similar to a doji, but the open and the close are just a little bit further spaced apart. And you can see that right here, this had an open and a close that was a little bit spaced apart, but it did have some wicks above and below. And it really doesn't help give any sort of direction analysis for the chart. Now what we have next is decisional candles. What are decisional candles? Well, we have what are called full-bodied candles, something similar to this candlestick right here, where basically we see there are some wicks on that candlestick, but the open and the close are pretty far spaced apart. This helps give a trader, when looking at this on a chart, an idea that the market price may continue to rally. Likewise, we also have a bearish full body candlestick right here. And what that helps the individual recognize is that the market price may decrease. We may see an overall decrease in market price because we can see there were some wicks, but the close price was well below the open price and formed a good amount of space between the open and the close. Now that you have an understanding of the different candlesticks, we are going to start diving into some common candlestick formations. Once again, there's hundreds of different candlestick formations that traders can utilize. I'm only going to be covering some of the more popular ones that a lot of traders like to utilize. I'm going to start off with what is called a morning star. What is a morning star? A morning star is basically a sequence of candlesticks. There's 3 candlesticks, and the very first candlestick is going to be a bearish candlestick, bearish full-bodied candlestick. Then to the middle, you will see a indecisional Dogee candlestick that basically shows that the market price is exhausted and it's really sticking at a price level here. And then to the right of that, we will see a full-bodied bullish candlestick. So how does an individual use this information for an entry? Well, if one recognizes this pattern and chooses to act on it, a trader would look at this as a bullish opportunity. Typically, these morning stars are found at the bottom of a trend and indicate a potential bullish reversal where the market price is projected to increase. So how does a trader utilize something like this? Well, once this candlestick formation has confirmed, and we can see that there is indeed a morning star, one can make a buying entry at the close of that candle and then set their stop and their take profit according to what their risk management plan establishes. The next candlestick formation I will be discussing is what is known as an evening star. An evening star is very similar to a morning star, except instead of being a bullish opportunity, this represents a bearish opportunity, meaning we are expecting the market price to decrease. So we're going to start off with a candlestick that is a full-bodied bullish candlestick, followed by a Dogee indecision candle right in the middle, and then to the right of that, a full-body bearish candlestick. Once a trader has determined that there is an evening star formation on the chart, they can look for a selling opportunity if it meets their risk management plan. So if an individual chooses, once it is recognized, they would place a selling order right when the candlestick closes. Then after that, they set their stop loss and their take profit according to their risk management plan. Once again, this is a bearish candlestick formation, and we typically do see these at the top of trends before the reversal occurs. Another common candlestick formation an individual may recognize on a chart is what is called a bullish engulfing candlestick. Now on this chart, here is an example of a bullish engulfing candlestick. Now what does that mean? Well, basically this single candle engulfs either the previous candlestick or the previous sequence of candlesticks, showing that the market price is ready to move upward. So as you can see, this candlestick closed above the previous candlestick movements. That means this engulfed all of that previous movement and signifies a potential bullish opportunity. How an individual would utilize this is once it is recognized, they can look for a buying opportunity at the close of the candlestick and then set their stop loss and take profits according to their risk management plan. The next candlestick we will be discussing is the bearish engulfing candlestick. Now on the chart, we can see that set up right here. And what this represents is one candlestick with a lot of selling pressure. It shows a full-bodied candlestick that engulfs the previous candlestick or the previous sequence of candlesticks. This is used by traders to help recognize a bearish trend, meaning a potential loss in price. So if an individual chooses to utilize one of these bearish engulfing candles, they would place a sell order at the close of that candlestick, and then they would place their stop loss and their take profit according to their risk management plan. The next candlestick formation that a lot of traders like to utilize is what is called a piercing line. On this chart, here's an example of a bullish piercing line. Now what this represents is two candlesticks. The first candlestick will be a bearish full-bodied candle, and the second will be a bullish full-bodied candle. So how is that determined? Well, basically you have the market price shown at a low level right here, and here would be the 50% line. The second candlestick has to cross that 50% line and close above that candle, such as this example here. So an individual would utilize something like this commonly to look for buying opportunities. How would they utilize it? They would place a buy entry at the close of that candlestick and then place a stop loss and a take profit according to their risk management plan. The bearish piercing line is going to be represented very similar to the bullish piercing line. You will have two candlesticks in succession. One right here would be your bullish candlestick, where it's a full-bodied bullish candlestick. The second would be a bearish full-bodied candlestick. Now you'll see here's the 50% line. The second candle did cross it and then close below, signifying a potential bearish reversal. So how would an individual utilize this? Place an entry right at the close of this candle, and then place their stop loss and take profit according to their risk management plan. As I said before, there's a ton of different candlestick formations. These are just some of the more common ones that a lot of traders like to utilize when helping recognize trading opportunities.